Thank you all for joining us in our second webinar in this series with AgriLogic. Today we'll go over whole farm revenue protection and microfarm programs. I'm joined here with Tom, Kim, and Brandon with AgriLogic. As always, if you have any questions, please put them in the chat or Q&A. We'll go through them towards the end. And yeah, I guess we can get started. Kim, take it away.
Okay, well, good morning, everyone, and welcome to the Whole Farm Revenue Protection and Microfarm Program training series. We appreciate you taking the time out of your schedule to learn a little bit more about this, and this will be recorded so that if you need to catch up with it, if there's something that I go through and you miss it, you can go back and look at it again. For those of you who've been on these series before, you remember Ethan typically did the presentations, and he had that nice, slow Texas drawl, which I am from the Midwest, and so I have that twangy, talk too fast kind of thing going on here. So if I get talking too fast, just say, whoa, whoa, and I'll slow her down just a little bit. But we appreciate you taking the time out during your lunch hour, and we're looking forward to spending the lunch hour with you. Let me go ahead and get started here. So just some backdrop on the participants that are bringing you these trainings. I am from AgriLogic Consulting, as well as Tom and Brandon. And we work with firms to work on training programs and presentations. And we also help to develop crop insurance programs and do financial and economic consulting. Farmers Veteran Coalition, which I'm sure you're all very familiar with who they are. And we also have partnered up with the USDA Risk Management Agency, who oversees the federal crop insurance program. And so this presentation and this training series is in partnership with the USDA Risk Management Agency under a grant award. So our objectives today is to summarize some benefits that are specifically geared towards veterans. And then we're also going to talk about the various components, updates, characteristics, et cetera, the federal whole farm revenue protection policy and the microfarm policy. And then we're going to give you some examples about how they work. So the first thing we're going to talk about is veteran farmer and rancher benefits. To qualify as a veteran farmer or rancher, you must be an individual who served on active duty or in the reserve components and was discharged under conditions other than dishonorable in all branches of the military. And we, of course, got them listed there. The qualifications that you must meet in order to qualify: either you have never owned or operated a farm or a ranch, you've operated a farm or ranch for not more than 5 years, or if you just become a veteran during the most recent 5 years, you will qualify even if you've previously operated a farm or a ranch for more than 5 years. If you have a business entity, for example, if you have a partnership, the entity will qualify as for the VFR benefits, provided everyone that has a 10% interest in the entity qualifies as a veteran farmer or rancher. However, if one of the partners does not qualify, then the entity does not qualify. And when we're talking about a spousal policy with a husband and a wife on the policy, if one is a veteran and the other is not, the policy is considered eligible for VFR benefits. So what are the benefits if I qualify? The first one is you don't pay any administrative fees on any federal crop insurance policy. On the catastrophic policies, which is the minimum coverage level, it's $655 that you won't be paying. And then buy-up coverage policies, it's $30, and this is on a crop per county basis. Additionally, federal crop insurance policies are subsidized by the federal government. Depending upon what coverage level, what policy determines what premium subsidy you will receive. However, if you qualify for a veteran farmer or rancher, you'll receive an additional 10% premium subsidy. In some of the policies, there's an ability to use a previous producer's production history. And this, being a veteran farmer or rancher, loosens up some of the requirements to be able to use those production histories. And then also there is a option that you can get in some of the policies. It's called a yield adjustment. It basically replaces a low yield that was due to an insurable cause of loss with 80% of the T yield. While under normal circumstances, it's 60% of the T yield. If you qualify for veteran and farmer, that gets bumped up to 80% of the T yield. So those are the benefits if you qualify as a veteran farmer or rancher. A beginning farmer and rancher has the same benefits as a veteran farmer and rancher, and you could qualify for both. The good news is it's the same benefits. So whether you do it under the veteran farmer and rancher or the beginning farmer and rancher will depend upon your circumstance. The qualifications for a beginning farmer and rancher must have operated a farmer or a ranch for no more than 5 crop years. If you're electing to whole farm revenue protection policy, that's 10 crop years. Some of the crop years that are excluded is when you were under the age of 18 years old. For example, if you farmed, you weren't 18 years old, that will not count against your qualifications. If you're enrolled in the years that you were enrolled in post-secondary studies, or in years in which you were in active duty in the U.S. military. So those don't count towards the 5 or 10 years qualification. And same as with the veterans farmer and rancher, you must be an individual. If it's a business or partnership, all SBIs have to qualify as a BFR, or beginning farmer and rancher. And then the third area we want to talk about is a limited resource farmer and rancher. And this is based on gross farm sales that are not greater than the current index value. And then also takes a look at household income. And so there's some qualifications when you meet to meet those there. So if you qualify as a limited resource farmer and rancher, there are technical assistance programs that are available through different USDA entities. And then under the federal crop insurance program, same as the BFR and the VFR, you will not have to pay the administrative fees. And you'll notice here that I'm using the BFR, the VFR, all the acronyms. And for those of you in the military, I'm sure you're feeling right at home right now because crop insurance is very similar. We live and die by our acronyms. So to see if you qualify, there is a limited resource farmer self-determination tool. And we've provided the link here that you can go to and you put in your information and it will tell you if you qualify for that. Also, your crop insurance agent can tell you as well if you qualify for any of these programs. Okay, so we're going to move into whole farm revenue protection and microfarm. As I mentioned, the whole farm revenue protection policy was the first one that was rolled out, and it has been refined through the years. And then the microfarm policy was released several years ago, and it's geared more towards smaller growers and has less requirements and paperwork. And we'll talk about some of those. So in the crop year, the 2023 crop year, on the microfarm side, there were 86 policies nationwide that had premium, a little over $6 million in liabilities and $800,000 in gross premium, and that is before the subsidies. And at this point, there were no indemnities paid out. On the whole farm revenue protection policy, a little over almost 1,700 policies that earned premium nationwide, with over $2 billion with a B dollars in liabilities, 135 million in gross premiums, and a little over $1 million in liabilities were paid out in the 2023 crop year. So the top states in terms of liability for whole farm revenue protection was Washington, with almost half of the liability, followed by California, Idaho, North Carolina, and Florida. And then in the microfarm top states, you've got Michigan at $3 million, Washington, Kentucky, California, and Minnesota. So you can see who usually the number one state seems to be where the primary amount of liability is coming out of. As far as important dates, there are several. We'll probably just cover a couple. And the first main one is right here in the beginning, the sales closing date, the very top one. If you are, so the whole farm revenue protection and the microfarm policy look at what type of tax filer are you? Do you file a calendar year, January to December, or maybe an early fiscal in the first part of the calendar year? Or are you a late fiscal year filer in the second half of the fiscal year? So whole farm revenue protection, if you are a calendar year filer from January to December or an early fiscal year filer, for whole farm revenue protection, you must see an agent and submit an application for coverage by January 31st, February 28th, or March 15th, depending upon which part of the country that you're in. For example, if you're in McAllen, Texas, it's going to be January 31st. If you're in Fargo, North Dakota, it's going to be March 15th. The microfarm policy sales closing dates are February 28th, March 31st, and April 15th. So you just need to find out in your area where that's at. Now, if you're a late fiscal year filer, everybody is November 20th. You're going to file a whole farm history report, which basically says, here's my revenue for the past several years. An intended farm operation report, which says this is what I expect or I intend to make as far as revenue for this current crop year. And then there will be a revised farm operation report that will be due in the middle of July, which basically looks at did I actually get what I intended to do done? Premium billing dates around August 15th. And the final one I want to talk about is the contract change date. That's when the risk management agency has to put out any new changes for the following year. And then the insurance period. Basically, if you're a calendar year filer, we're covering the insurance period from January 1 to December 31st. If you're a fiscal year filer, we're going to be looking at the fiscal year. It'll be the term of your fiscal year when your taxes cover. So to get into whole farm revenue protection, this is a policy that covers all commodities on your farm in one policy. And at the end of the day, your income from all of the policies are going to be lumped together to see if you have an overall loss on your farm. Post-production and value-added costs, for example, jams, pies, canning, things along that line, are not included in your approved revenue. Moving a little slow here. And then there is a limitation, farms up to 17 million in insured revenue. And remember, that is insured revenue, not your expected revenue. So we'll talk about that a little bit later. Because your coverage level determines when you meet that $17 million. Some of the products that are not covered are timber, forest products, sport and show animals, and pets. Commodities that you purchase for resale can equal up to 50% of your expected revenue. There are some limitations on in that 17 million of up to 17 million of insured revenue. The animal products are limited to $2 million in expected revenue. So that would be your historic or your expected revenue. And then greenhouse and nursery is limited to your expected revenue. And I misspoke there. It is expected revenue, not historical. So there's some limitations on those two items. You can buy a whole farm revenue protection policy and have in another federal MPCI program, for example, yield protection, actual production history, revenue protection, in conjunction with that whole farm policy. So for example, if you have an actual production history policy that covers your production on your, let's use grapes, and there is a loss on that policy, that indemnity payment that you receive is considered part of your revenue for the current year for whole farm protection. And there is replant coverage for everything except hemp and those that are covered under other federal insurance policy and commodities that you have covered under other federal policies. So we're going to move into some of the details on the micro farm. It's kind of a more streamlined, makes it a little easier version of the whole farm. And the whole idea is for small producers that have smaller operations. Post-production and value-added costs may be included in the approved revenue. There's some qualifications on that. And then this limits operation sizes up to $350,000 in approved revenue for the first year and $400,000 for the years following. So there's some limitations on your size. And as with the whole farm revenue protection, timber, forest products, etc., they are not included under the micro farm policy. You are eligible for microfarm if you are a vertically integrated grower or have other federal crop insurance policies. These were two exclusions in previous years. So this is new for 2024, which this is good news. So if you have, and we've got some other changes for 2024 that may change. If you've looked into whole farm in the past, there are some changes for the 2024 crop year that you may want to check with an agent on those. Now, we are past the January 31st sales closing, so it will only apply to those of you in February 28th to March 15th timeframe. So you might want to be finding your agent soon if you want to talk about that. And then under microfarm policies, there is no replant coverage under it. So what do we need to get started? Of course, you'll need to have an application filled out with your crop insurance agent. And then you'll need a Schedule F or other farm tax form off of your taxes. For whole farm revenue protection, you'll need 5 years of Schedule F. But if you're a beginning farm or a veteran farmer and rancher, it's 3 years. And then 3 years for microfarm. If you don't have a Schedule F, there are some substitute tax or substitute forms that you can use to try to, especially like if this is your first year, you haven't filed yet as a Schedule F, or you're tax exempt or something along that line. So coverage, approved revenue. So when we talk about approved revenue, this is the amount that you're going to be insuring. And so it is the lower of your expected revenue. So what I expect, for example, I expect to plant X acres of strawberries this year and 30 acres of pumpkins this year. That's my expected revenue. We determine how many acres, we determine a value, a yield and a price, and come up with an expected revenue. Or it's your adjusted historic average revenue. So the reason you have these Schedule F forms is you're reporting your historical average. You're determining what your historical average is. And so whichever one of those is lower is what you're going to be insuring for this year. This policy covers revenue produced during the insurance period for most of your annual crops and perennial crops that are harvested during your tax filing period. That's fairly straightforward. But when you get into some of the livestock, you may start with a calf here, but it doesn't get sold, until it's over a year old. So you're going to look at what it was worth at the beginning of the year, what it was worth at the end of the year, even if you haven't sold it. And that's the revenue that you're covering. Your insured revenue is your approved yield, or I'm sorry, your approved revenue times the coverage level that you elect. Remember, anywhere from 50 to 85% coverage. So when we're talking about that $17 or $17 million cap, we're looking at your approved revenue times whatever your coverage level cannot exceed that $17 million cap. Got a little ahead of myself. Coverage levels are anywhere from 50 to 85%. CAT coverage is short for catastrophic coverage. And under a lot of the federal crop insurance programs, it is available. However, it is not available under the whole farm and micro farm. And then new for 2024, and this is a kind of a big deal if you've only got 1 or 2 commodities. You now qualify for 80 and 85% coverage level. Previously, you had to have at least 3 commodities to qualify for 80 and 85% coverage level. So that is new for the 2024 crop year. Your price and yield to determine your expected yield or expected value for this year is determined. It's whatever you can expect to receive when you harvest and sell that commodity. And the policy outlines the sources of where that can come from. It could be a marketing contract that you have. It could be a price that the RMA uses for crop insurance policies and prices received, et cetera. So there are several different places you can get that price. The yield is what you can expect to grow under normal growing conditions. And basically, we typically look back at what did you grow in historically. But there are other sources that can be used as well, and the policy lays those out. Individual commodities under the microfarm are not required to have separate expected values. So that's one of the differences between microfarm and whole farm. So I've got a whole farm policy, and now I'm going to expand. I'm going to pick up some acres. Can this policy grow with me? And the answer is yes, it can be. It can be increased by using an indexing procedure as long as you have 5 years of tax forms, and the allowable revenue in either the 2 most recent tax years is greater than your simple average. So it allows up to 35% growth over your historic average. There's also an option that you can select to adjust for bad production years. So say we had a drought and you had a really, really bad production year. And now that's in your history and it's kind of pulling your revenue history down. So there's a 90% approved revenue cup for that, and revenue exclusion and revenue substitution. So these are ways that you can mitigate the, the drag that a really bad year has on your revenue, your historical revenue. Your commodity count. So when we're looking at your operation, we're going to determine a commodity count. And that's really important because it determines how much rate discount you get on your premium. So when your premium is calculated, a premium is calculated, and then there's a discount based on how many commodities you have. If you have the more commodities you have, the higher that discount is because you're spreading your risk out over multiple commodities. It also determines your subsidy factor. The more commodities you have, the higher your subsidy factor gets. If you're growing potatoes, you have to have more than one. This policy will not work for just potatoes. You have to have more than one commodity. Or if you have an if the MPCI revenue program is available for the commodity that you're insuring, you have to have at least two. And this chart that we have here, this is the subsidy factor. So remember I mentioned that the federal government pays part of the premium. So you can see here, any coverage level up to 70%, you're only going to be paying 20% of the premium. Once you get above 70%, the amount changes is depending on whether you have one commodity or if you have two or more. And this is new for 2024, as I mentioned earlier. Those higher subsidies were not available for policies that only had one commodity. So this is a really nice improvement, enhancement that they made for the 2024 crop year. So your commodity count is determined. It's not the number of commodities that you've produced in this that you're going to be producing, but there's a calculation, and that's basically to determine you could have like one cow, and you're insuring a whole bunch of other things. That one cow shouldn't count as a commodity count because it's such a small portion of your operation. So I'm going to walk through a commodity count example here. On this sample growers operation, they have cut flowers that are valued at $325, bees at $800, or their products, tomatoes $4,500, and hay at around $7,400 worth of value. When you add those all together, that is the total expected revenue for the 2024. We're going to assume this is 2024 crop year. My expected revenue for the year, what I expect to grow or get in return, is $13,000. So that's 4 commodities produced. So the step one, we're going to divide the one by the number of commodities. So there's 4 commodities, so each get a value of 25%. And then we're going to take that times a third. So 0.25 times 0.333, our factor is 0.083. So we take that total $13,000 expected revenue times the 0.083, and that gives us a value of $1,079. In order to count as a commodity, it has to be, the expected value has to be in excess of $1,079. So you can see both tomatoes and hay would count as one, so that would count as 2 commodities on this particular policy. But because cut flowers and bees are less than $1,000, they do not count as a commodity. However, it does allow us to add cut flowers and bees together, and together they exceed $1,079. So therefore, they count as one. So we've got 3 commodities on this particular example. We've got the cut flowers and bees together, and then we got the tomatoes and hay, each counting as 1. Causes of loss is adverse weather conditions, which would be too much rain, too little rain, snow, tornado, hail, etc. Fire, insects. Of course, you have to be applying pest control measures that are common and standard for the crop you're growing. Plant or animal disease. Again, you have to have application of disease control measures. Earthquake, volcanic eruption, and failure of the irrigation water supply. And that's only if it's caused by an insured peril that occurred during the insurance period. And then wildlife is also a covered cause of loss under the whole farm revenue protection. And finally, a drop in revenue due to a drop in your market prices. I'm going to stop here real quick and see, do we have any questions? And I'm going to take a quick sip here for the dry mouth. Any questions that we have out there, Diego?
We do have a question, Kim, and I've been digging in to try to verify the answer. Maybe you know off the top of your head. The question from Ryan is to exempt from years farmed, and this is regarding the beginning farmer and rancher benefits. As a student enrolled in post-secondary school, does your status have to be full-time student or does part-time qualify?
I'm going to have to go back and look that up, but I'm pretty sure it's full-time. And Brandon, you might look on the quick sheet, or it would be in the actual provisions, and we can look that up. But and I'm going off memory here, and that's never a good thing. So we will get back to you with that, Ryan.
Then we have one. What if I do not have my DD 214?
Oh, for the, I think there are some, we're going to have to look that one up. I think there are some provisions that are in the policy that we'd have to look that up. And your agent can help you with that as well. Because you're going to have some evidence that you're a veteran. And you're discharged, so.
And then finally, another one from Angela. Can you get coverage for your farm if you use raised beds? I'm in an urban environment and a very small operation.
Yes. Are you talking like under greenhouse or outdoors? Well, how about we get back on that, because I've got some other questions that I want to ask on that. So
outdoors.
Okay.
Outdoors.
The raised beds, you're talking like it. Well, I've got several questions I need to check there, but I'm fairly confident they would be, Angela, but I do have a couple questions I want to ask. So this may be a situation where we, talk after this webinar or do some emails. So if you would send your email to Diego and he can get it to me so we can follow up with you on that. The one thing about crop insurance, there are so many variables and things that you might not even know about or in the policy until somebody actually asks that question. So you definitely want to make sure we have the right answer. So okay, so how do I have a claim? How do I know if I have a claim? Well, first of all, you got to file your taxes. So with this policy, the claim settlement procedure does not start till after your taxes are filed for that policy year. So there is a bit of a delay when, as far as determining if you have a claim and getting you paid for your loss. If your revenue to count, which is the value of what you actually produced, falls below your insured revenue, you will have an indemnity, of course, assuming it's due to an insured cause of loss. All right. Revenue to count. So when we're talking about revenue to count, it's approved revenue from the tax form, and then it's adjusted. We exclude inventory from commodities that were produced in the previous year that were sold during the tax year. So let's say you grew it last year, but you sold it this year, you've had it in storage. Those would be excluded. And we include values of commodities that were produced during the tax year but haven't been sold yet. Back to my example, you're feeding out calves or something along the line, you haven't sold them yet, but what was their beginning weight, what was their ending weight? So, and then there's some required by the policy, such as an uninsured cause of loss. For example, your neighbor sets everything on fire because he's burning his trash, something along that line. So, okay. We're going to walk through some examples here. On this particular operation, the approved revenue, will calculate it. They've got 4 commodities here. So the total expected revenue, if you add all those together, is $19,000. So we're going to walk through the commodity count steps. we're going to divide 1 by the number of commodities, which is 4, and we're going to multiply that by 0.333. Again, this is the same as our earlier example, 0.083. We'll take that times the $19,000 to get the threshold of whether or not a commodity counts as a count. And so you can see bees, eggs, and poultry all exceed that amount, but peaches do not. So for this example, we have 3 commodities. When we're looking at our premium rates, our subsidies, and things along that line, we will be using 3. Okay, so producer elects 80% coverage level. We're going to take that $19,000 expected revenue times 80% to get an insured revenue of $15,200. I do want to mention here, we are making an assumption on this that the total expected revenue is lower than their historical revenue, because if the historical revenue was lower, we would be using historical revenue. But in this particular example, we're using the expected revenue, what I expect to grow this year, times 80%. And again, that value there has to be less than 17 million, which is more than, falls way below that. So the revenue to count, from my crop year, so let's assume I'm a calendar year, from January 1 to December 31st, what was my revenue to count for the crop year from these 4 commodities? And it was $7,500. So we're going to subtract that from the $15,200, and that gets us a $7,700 indemnity. Another assumption we made here is I had 100% share in all of those products as well. So, and there's not any kind of a multiple policy kind of thing. On the microfarm side of it, in this example, the producer elects 60% coverage level. They've got $700 worth of pecans, $1,600 of apples, and $3,200 worth of goat products, whether it's milk or meat, anything along that line. My total expected revenue from these sources is $5,500. Again, we're looking at the insured revenue of $3,300. We didn't, in this example, go through the count here. Just looking at a top, just guessing, I'd almost guess that we have 3 commodities here, but have to work through the factors. For the example that we're looking at here, it's not as big a deal. Revenue to count is $2,200. So $3,300 minus $2,200 is $1,100 indemnity on this one. So just a side-by-side of the microfarm comparison, the whole farm revenue protection versus microfarm. On whole farm, you need 5 years of your Schedule F for your historical, 3 if you qualify for a beginning farmer and rancher or a veteran farmer and rancher. On the microfarm, it's just 3 years. On the whole farm, post-production costs are excluded. On the microfarm, some may be included. Whole farm's got a little more paperwork. Microfarm's got a little less paperwork because the microfarm was geared towards smaller producers and has less paperwork. And then there is replant coverage under whole farm, but not under microfarm. The bottom line is it's a safety net for all of the commodities on your farm. This policy is geared towards covering your entire operation, not just a part of it. And then I wanted to point out the Risk Management Agency. They have a whole farm and microfarm page, and it is full of a lot of good information. I've got the QR code there. We also have the link to it, but it has all of the policy documents. There are fact sheets, which kind of give you an overview of each of these policies that we had here. There's frequently asked questions section that, any question that's been asked up to this point on either of these policies are laid out, and then the answer is provided. There's also a list of whole farm and microfarm agents. So basically agents who, because this is different than your traditional crop insurance policy, not all agents study up on it. And so this provided a resource for those agents that really want to provide cover, or when you really want to work with whole farm customers or microfarm customers. They're out there with their contact information. So you can, there's like a whole spreadsheet that you can download and try to find one in your area. Another thing that I tell producers to do when they're looking for a good agent is to ask around, who's your agent? Because not all agents are created equal. Some put a lot of time and effort into making sure they know what the product is about, and some don't put as much time. So choose your agents wisely and ask a lot of questions. There's a very good PowerPoint that RMA has put together. It's a lot more in depth. We tried to cover for this purpose of this presentation. Get my tongue untied here. We're trying to cover just the highlights of it to make you aware that it's out there, give you some of the high points of it, but we didn't go, real deep into it at this point. So their PowerPoint has a little bit more information, is a little far deeper into it. There's some record keeping aids and some interpretations of procedure that have happened during the course of the policy. Excuse me, apologize. So upcoming webinars, we did a record keeping one back in November. January, we did livestock. And of course, now we've got the whole farm one completed. On March 12th, we're looking at an actual production history program. One moment, please. I apologize. It is wintertime in the Midwest and it is dry. Actual production history, primarily used for a lot of perennial crops and a lot of the most of the crops that don't have like a board of a trade or exchange. So for example, your grapes, your strawberries, things, well, not strawberries, but grapes, dry beans, things along that line. Then on April 9th, we'll be looking at the grapevine and tree programs. So these programs are a little different in that they insure the actual tree, or the actual, in case of grapevine, which is a newer product, they insure the actual grapevine itself from death or damage due to an insured covered peril, not the fruit, but the actual vine or tree itself. On May 7th, we're going to be talking about general liability and record keeping. And in June, we'll be discussing food safety. July, we'll be talking about apiculture, which is beekeeping, pasture, rangeland, and forage. And in July is the FSA and other risk management programs section that will be discussing some other opportunities out there for risk management. And then finally, in August, we're going to have kind of an open panel discussion, Q&A. Some folks come in and it'll be just open to your questions. So that concludes our webinar. Any questions, Diego, that we need to respond to?
Yeah, we have several, Kim.
Oh, Brandon, I'm sorry, I did say that.
One from Michelle is, I had a calf born in 2023. I had no coverage. Can I include it this year?
Yes, so the policy, you'll do an beginning livestock inventory and an ending livestock, and you're ensuring the value, the gain of value on that calf for this year.
Okay. All right. And then we have a question from Angela about, as a beginning farmer, with this year being the initial year growing, our projections allowed for obtaining insurance, or in other words, if she can't provide revenue info because this is her first year as a beginning farmer, so I go seeking insurance. I have no Schedule F to show revenue, although I'll have costs incurred because my farm went official in 2023. So kind of just that delay in gathering everything needed at the beginning.
Right. And so there are some terms in the policy to provide if you don't have a Schedule F. I think we kind of covered it briefly, but there are ways to come up with information for your expected revenue. So you'll need to work with an agent on that as far as your particular operation.
And then back to Ryan's question about full-time or part-time. I've done some digging, and all I can come up with is language regarding being enrolled in post-secondary education. I haven't come across specifics about full-time or part-time.
Yeah. I'm pretty sure it's full-time, but Ryan, if you would send Diego your email address and I will get that back to you. I just got to find where the actual language is. I don't want to say it is and then find out it's not. So
And looks like Diego just popped his email address there in the
There you
chat
go.
box. And
Okay.
that's all the questions that I see, Kim.
Okay, all right. Well, cool beans. Well, if anybody has any questions, in addition to that, please just let us know and we will do our best. And again, every operation is different. Every operation has things that we may not think to ask you about. So a good agent can help you work through some of these scenarios. An agent will not require it's not like you walk in and you have to buy something. You can go in and ask for information and they can help walk you through the process. And then
Thank you
Diego,
for
that's
that,
all I
Kim.
have.
Thank you for that. And just to repeat what they said, I put my email in the chat. So if you have any questions, feel free to send them to me and then I can forward them to Kim and Brandon to help answer the questions. But yeah, thank you all for joining us again for this webinar. Right now, I'm about to put the link to our YouTube channel because again, this is being recorded. It'll be uploaded by the end of the week. So for you to view on your own time again. And also I'd like to throw in our newsletter that is sent out monthly. If you want to stay in touch with what's going on with FEC, I highly recommend you sign up for that. Other than that though, thank you for joining us. If you have any questions again, feel free to reach out to me and I can get those answered. And yeah, anything else, Kim?
No, I do see a Kirksville, Missouri here. Kudos to Northeast Missouri, which is where I started out from. So
All right. So, and be on the lookout. We have our next webinar on March 12th. So hopefully we'll see y'all again. And thank you all for joining. You have a great day. Thank you, Kim, Brandon, and Tom.
thank you all.